Welcome to Dividend Fortress. For investors seeking a reliable and growing stream of passive income, dividend exchange-traded funds, or ETFs, represent a powerful tool. They offer instant diversification and a systematic approach to investing in companies that reward shareholders. Instead of picking individual stocks, these funds provide access to a curated portfolio managed according to a specific, rule-based strategy. This allows investors to build a resilient portfolio designed for sustainable cash flow, a cornerstone of financial independence. In the world of dividend ETFs, two names consistently rise to the top: the Schwab U.S. Dividend Equity ETF, ticker SCHD, and the iShares Core Dividend Growth ETF, ticker Dgro. While both are considered premier choices, they operate on fundamentally different philosophies. SCHD is the established champion of quality and value, while Dgro is the formidable challenger focused on future growth. Understanding their distinct methodologies is critical to selecting the right foundation for your portfolio. The investment philosophy of SCHD is anchored in a dual focus: current quality and demonstrated value. It seeks to identify companies that are not just dividend payers, but are fundamentally robust right now. Its methodology is built on the premise that a long history of consistent dividend payments is a powerful indicator of financial stability and a resilient business model. This isn't about chasing future potential. It's about investing in proven, present-day performance and financial health. The first and most fundamental filter for SCHD is uncompromising. To even be considered for inclusion, a company must have a history of paying dividends consecutively for at least 10 years. This strict requirement immediately screens for maturity and reliability, eliminating companies with inconsistent track records or those new to paying dividends. It's the initial, data-driven step to ensure that the fund is built upon a foundation of established, dividend-paying enterprises. After the 10-year screen, qualifying stocks are ranked by four equally weighted fundamental metrics. These are free cash flow to total debt, measuring a company's ability to cover its obligations; return on equity, a gauge of management's efficiency; the current dividend yield; and the 5-year dividend growth rate. This multifaceted approach ensures that only companies displaying a holistic combination of financial health, profitability, and a commitment to shareholder returns make the final cut. This rigorous selection process results in a concentrated portfolio of approximately 100 blue-chip stocks. The portfolio is typically overweight in historically stable sectors like financials, industrials, healthcare, and consumer staples. You'll find established giants like Coca-Cola, Verizon, and the Home Depot. This composition gives SCHD a defensive character, focusing on companies with time-tested business models, which tends to provide stability during periods of economic uncertainty. A significant and often understated advantage of SCHD is its cost efficiency. With an expense ratio of approximately 0.06%, it is one of the lowest cost ETFs available. For the long-term investor, minimizing costs is crucial. A lower expense ratio means more of your investment returns are reinvested and compounded over time, rather than being paid out in fees. This disciplined approach to cost contributes directly to maximizing an investor's total return over the long haul. Now let's turn to Dgro. Managed by BlackRock, its philosophy is centered on a different objective: identifying companies with a strong capacity for sustainable dividend growth. The core belief is that a consistent record of increasing dividends is a reflection of superior financial health and a durable competitive advantage. Dgro is designed for investors who prioritize the future growth rate of their income stream over the absolute level of yield today. Dgro's primary screening criterion is a history of at least 5 consecutive years of dividend growth. This shorter 5-year window, compared to Sched's 10-year payment history, is a deliberate choice. It allows the fund to capture high-quality companies that may be earlier in their dividend-growing journey. This includes technology giants like Microsoft and Apple, which began their dividend programs more recently but have shown strong growth. One of Dgro's smartest features is its defense against dividend traps. The fund explicitly excludes companies that fall within the top 10% of the market by dividend yield. While a very high yield might seem attractive, it can often be a red flag, signaling a falling stock price or an unsustainable payout. By avoiding these potential traps, Dgro prioritizes the safety and sustainability of the dividend over a high but potentially risky yield. To further ensure sustainability, Dgro applies another critical filter. A company's dividend payout ratio must not exceed 75%. This means the company is paying out less than 75% of its earnings as dividends. This rule ensures that a company retains sufficient capital to reinvest in its own business for future growth and to provide a buffer during economic downturns. It is a powerful indicator of a dividend's long-term viability. The result of Dgro's methodology is a much more diversified portfolio, typically holding over 400 different stocks. This is about 4 times the number of holdings in Schd. This broader diversification can reduce company-specific risk. The sector allocation is also more balanced and often includes a larger weight in information technology compared to Schd. The portfolio is a blend of established leaders and companies still in their strong growth phase, such as Microsoft, ExxonMobil, and Johnson & Johnson. So, how do these philosophies compare directly? Think of it this way. Schd is like buying a mature, established orchard. The trees are strong and are already producing a bountiful harvest today. Dgro, in contrast, is like investing in a well-managed grove of younger, healthy trees. The initial harvest might be smaller, but the potential for significantly larger yields in the future is the primary focus. One prioritizes today's harvest, the other cultivates tomorrow's. This difference in philosophy leads to distinct portfolio structures. Schd is concentrated, holding around 100 stocks selective for deep value and quality. It makes a targeted bet on a select group of high-quality companies. Dgro is diversified, holding over 400 stocks to capture a broad swath of the dividend growth market. The choice here is between a focused portfolio of proven winners versus a wider, more diversified approach to mitigate risk. When we analyze the dividends themselves, a clear pattern emerges. Schd almost always offers a higher starting dividend yield, as this is one of its selection criteria. Conversely,
Dgro has historically demonstrated a faster rate of dividend growth year over year. This is the central trade-off. Do you prefer more income in your pocket today, as with Schd, or a smaller income stream that is expected to grow more rapidly in the future, as with Dgro?
Performance is highly dependent on the market cycle. During strong bull markets, Dgro's exposure to growth-oriented sectors like technology can give it an edge in total return. Its holdings may appreciate more in price. During bear markets or periods of volatility, Sched's focus on high-quality, stable, value-oriented companies tends to make it more defensive. It may experience smaller drawdowns, offering better capital preservation. For any international investor, a critical factor is withholding tax. By default, dividends from U.S. ETFs are subject to a 30% tax. However, investors in countries with a tax treaty with the U.S., like Indonesia, can reduce this rate significantly. By submitting a W-8BEN form through your broker, this tax can be lowered to 15%. This is a crucial step that directly impacts your net returns, and it should not be overlooked. Finally, remember that your investment will be held in U.S. dollars. This introduces currency risk. If the U.S. dollar strengthens against your home currency, the value of your investment increases. If your home currency strengthens, the value of your investment when converted back will decrease. This is an inherent risk in global investing that investors must be aware of and prepared to accept. So, which is right for you? Consider two profiles. An investor approaching retirement who prioritizes stable, high current income and lower volatility would likely find Schd to be a more suitable choice. Its defensive nature and higher yield align with capital preservation and income generation. In contrast, a younger investor in the wealth accumulation phase with a multi-decade time horizon would logically favor Dgro for its focus on dividend growth and higher potential for capital appreciation. There is no absolute winner in this comparison. The optimal choice depends entirely on your individual financial goals. However, you don't have to choose just one. A powerful strategy is to own both. Combining Schd and Dgro, perhaps in a 50-50 allocation, creates a highly diversified, robust portfolio. This hybrid approach balances the need for current income and stability with the long-term potential for growth, giving you the best of both worlds.